Get into it for today. This is the Kingscrowd Podcast. My name is Brian Belley. I am joined, as always, by industry insider Scott Kitun and senior investment associate here at Kingscrowd, Teddy Lyons. We have a very full agenda for today because a lot is happening in the online private markets. Now, each week we cover all the different insights, trends, data analysis, deals, and everything else happening for investors who are looking to invest in deals online, as well as founders who are raising capital. Now, a couple of things have happened over the past few weeks that we wanted to touch on today in the news. We will be jumping into the executive order signed by President Trump that is going to open up 401k plans and retirement plans to private assets. Now, that includes things like crypto, which has been getting a lot of headline and news about, but that potentially also opens it up to investment crowdfunding opportunities. So we'll be talking about that. Second thing is Boxabl, one of the big online repeat crowdfunders, has announced a SPAC deal. So they are potentially going to be going public via a SPAC. We will discuss that. In addition to that, the House has recently passed a couple of different bills around accredited investors. So we'll be talking about what that means for the industry, for investors especially. If you're not accredited today, we know a lot of people out there are kind of on that line of being pretty close or wish you could be accredited to be able to invest in Reg Ds. This may open up some of those opportunities to you. All right, let's get into our busy news schedule this week. Now, Boxabl is a company that is a repeat crowdfunding deal. They've done multiple lines. I can pull up my screen here and show some of their raises. They have recently announced, as of August 2025, that they will be going public in a $3.5 billion SPAC deal. Now, Teddy, I think you have kind of seen some of these SPACs before. Why don't you just give us a quick overview? Like, what is a SPAC? How does that work?
Yes, so a SPAC is a special purpose acquisition company. So essentially what it is a group of sponsors, so like investors, private equity firms, they will go public. They will form a shell company essentially that has no product, no business plan, nothing, basically just a management team. And because of that, there's not a ton for the SEC to really look at and regulate. So they can go public pretty quickly. They will raise funds, primary shares in that shell company. And afterwards, once the funds are raised through the IPO process, the company then has generally 2 years to find an acquisition target. And so that's basically, they'll go out in the market and, review companies that might be good candidates for, if the SPAC has a target industry, whether I think they really started in the oil and gas industry, but, we've seen a lot of different tech companies go public via SPAC. So once the target company is met with, agreed with on terms and all that, they will, what's called a reverse merger and a de-SPAC process will go into place where the shell company, the target company will combine. And in the end, you will have a public company that, the target company will be a public company. So obviously there are a lot of risks that, I'm sure you can guess what some of the risks are, but, when a SPAC is raising money, they're often called blank check companies because investors investing in an IPO like this, they don't know what the target company is going to be. You're basically just giving your money to this shell company, this group of sponsors that you're basically trusting are going to find an attractive investment target. And there's all kinds of misaligned incentives there. Obviously, the sponsors are incentivized to get a deal done before the 2-year shot clock is expired. So especially as you get to the end of the timeline there, they might be incentivized to kind of close on a deal, even if it's not in the best interest of all investors, because they stand to profit from it no matter what if they close it. And just a quick stat, I don't know how out of date this is, but PitchBook reported that 800 out of the last 1,300 SPACs created since 2020 are still looking for their acquisition targets. So there was really a SPAC mania. I was in investment banking during the 2021 SPAC mania. It was
keep your boys an open door, baby. Let's go. Come on.
It was something else. But I think it's the data is pretty clear that SPACs over time have consistently underperformed the market. And oftentimes, investors see see some pretty heavy losses there. But anyway, that's kind of an overview. They're, for lack of a better term, can be very sketchy and are not something I have ever invested in. So
yeah, so a lot could be said, I think, on SPACs, and I'm so glad that I handed that over to you, Teddy, because you are a wealth of knowledge on that. I put you on the spot. There was no preparation done in advance of that. But let's talk about Boxabl specifically. Like, what does this mean? Scott, you've seen a couple of these deals now either go public via SPACs or via IPOs, but we can see the funding history here for Boxabl. All the way back in 2021, they did their first online crowdfunding raise at a $42 million valuation. Obviously quickly jumped up to a $3.5 billion valuation. Sounds like the SPAC deal is probably going to close around a $3.5 billion SPAC. What does this potentially mean for investors? What are your thoughts on this?
For Boxabl, this is about the most on-brand shit I've ever seen in my life. One, on the SPAC side, like, they're not all evil. There are some times where a SPAC is just better because of the complication of the business. Like, Open Door has been a disaster, but I actually still have some Open Door stock, mostly because it's down too much to sell. And right now it's a target of the Wall Street Bets crowd. But there is actually a business there. Like, I would sell if it got back to like $7, but like there's a real business there. So I'm not crapping on all of them. The Boxabl thing, it's just like, how many times can you do mini IPO before you do a real IPO? And I think it's, again, I do not have any information here. I'm not suggesting anything nefarious or anything of that sort, but it just seems to me that every single time there's a way to skate or skirt revealing sales and having more to offer than like wait list numbers and like show me the number of box homes around, they just don't ever do it. And like the father-son combo, it just is, there's just something there that's just kind of crazy. And like, I hope that everything's real, and I hope that this works out for them. And in particular, I hope this works out for the investors who put in at the 40 million value, which I know Brian will get into, that there's a differentiator there that we got to talk about, which is important. But like, how many years of this have we been raising at 3 billion? And then you're telling me the grand payoff for all of us typically is the IPO. And not only are you not going to do a direct listing, which, obviously you could have a real IPO, not to say they're not real, but you know what I'm saying, like traditional. You could do a traditional IPO. That's not ever going to happen. Like, I think everyone here knows why. We won't have to say why. They could do the Coinbase style direct listing, which they, and I think Reddit also made very popular. But again, for the reasons that we won't talk about on the show, they won't do that either. So it leaves them with a SPAC. And to me, it pisses me off, frankly, because I look at the history of raises you have here, and I show, basically just raising again and again and again at the same value, incremental, no incremental growth, no return on investment, no potential return on investment. And so then I'm going to hand it back to you, Brian, with saying this: they're going to go public, and if it's like Open Door, the price will drive itself up to $14 or $15, or maybe in this case, depends on what they list at, but it'll be $7, or again, whatever the case may be. And then it finds itself under $1 in about 2 weeks, or even a day in some cases. And so even for the people who invested here, I guess the positive news is if you invested as a Reg A, you, I guess, technically could sell your shares there, and it's a way to get your money back. But if you've invested at a 3.5 billion value, unless this thing pumps to 5, 6, 7, 8, 9, 10 billion valuation on IPO day, they're not really going to get a return. They just get they got about a 24-hour, 18-hour window to get the hell out of Dodge just to return their money. And then the people who stand to gain the most, who should be the most excited, are the earlier backers, of which I was one, at the 40 million value. But the problem there, Brian, is that it's a CF, not a Reg A. And what does that mean to us?
Yeah. So I've had a few of these now, not necessarily via SPAC, but via IPO. And granted, they can all be a little bit different. So some of the hypotheticals, though, that I think you're alluding to, Scott, is when you sell shares via a Reg CF, a regulation crowdfunding, there's certain restrictions and everything on those shares, and you have to do certain types of filings, like your S1 filing, which is to go public, in order to make those shares tradable. Now, Reg A Plus, technically, when you do that offering under Reg A Plus, those shares can be immediately liquid. So depending on the type of public offering, Newsmax is maybe a good example of this.
Yes.
Again, I was not a part of that, but they kind of went public via Reg A and then uplisted those shares to the exchange to kind of make them tradable, right? So they were immediately tradable.
Which, by the way, Brian, real quick, that is how one would do it coming from this retail online space. I, again, reiterate, with all lawyers' approval, I do not know anything at all about Boxabl, the SPAC, the people, nothing. What I do know, what my eyes tell me, is that there is a precedent and a absolutely foolproof, proven methodology as to how to go CF, Reg A, mini IPO, public, and do so in a fashion where everyone gets to see everything and it's all in line. And that doesn't mean that the stock isn't volatile and all that. That's not up to us to debate. That's the market telling you that. It's how they do this, and that's the part that I'm like,
Yeah. And so what can happen, and again, it depends on the process through which they're going public, but the shares basically have to be registered. And so what you can have, so this happened with a company I can talk about that I invested in called Atlas Motor Vehicles. I invested very early on Start Engine. It was a $2.9 million valuation. Honestly, I'd love to tell you that I was forward thinking and I saw the future of EVs. They were raffling away a free electric truck right at the time, probably a big part of my very small investment. Now, that being said, you can see they, in a few years, went up to a $1.9 billion valuation. They actually ended up doing an IPO through an S1. What happened is that because of the way that they registered their shares, Reg A shares, I believe, were tradable on day one. My Reg CF shares were actually locked up. This is kind of different than the typical lockup you hear about after a post-IPO lockup for like 180 days. That's usually for like larger insiders to make sure they don't dump all their shares, that sort of thing, like officers and directors. But my shares weren't tradable for Reg CF. So what happened, I bought at 29 cents a share. Around this time, I think it was around $29 a share. At one point, it traded at $290 per share. I could not trade any of my shares until it came back down. Now I still got out with a return, but if you look at the stock today, it split adjusted is very, very low. So they kind of rebranded. You can see split adjusted, the IPO price was 700,000 and it's now worth a tenth of a cent. So all that being said, the thing for investors to understand, and I just hope that Boxabl is thinking about this in advance, is making sure that as much as they can, that they're communicating with investors. If you're an investor, you want to think about if your shares are with a transfer agent. I don't know where some of these shares are being held. Start Engine does have, I believe, their own transfer agent. So maybe it's with Start Engine, maybe it's with someone else. You want to figure out in advance of the IPO day, how do you get access to your shares? You usually need to transfer those shares to your broker so you can then sell them. That process through the DRS can take weeks sometimes. Sometimes it can be quicker. So these are all just things that can mean, like, even though IPO might happen day one and you might see the price spike, you want to think about, do you need access to your shares, and start thinking about that process before that day. So I land on that. Again, it's all speculation. This could go public via the SPAC. It could be super successful, right? And they have a lot of VC backers. So, part of that is they probably need liquidity for some of their investors. But I'm hoping / assuming that for the online crowdfunding investors' sake, that a lot of those VCs probably have more of these formal lockup agreements for the larger investment amounts. But all that being said, that's kind of the 2 cents, the quick story there.
Yep. Well, say part of the challenge between the crowdfunding CF reg and the A has something to do with accreditation, right, Brian?
Accreditation. Thank you, Scott, for that segue and moving us on to our next topic. Yeah, so there's been a few bills that we just wanted to briefly talk about that have passed the House in the past couple months. So these two bills have been focused around, have had parts contributing to the accredited investor definition. As a refresher, right, accredited investor definition today, you need to have $200,000 in annual income for the past 2 years, or $300,000 joint with your spouse, or have a net worth of $1 million excluding your primary residence. If you meet those traditional wealth thresholds, you are considered accredited. There were a few other quick updates that the SEC made to that, where you can have certain professional financial licenses now, like Series 7, Series 62, that type of thing, also be considered an accredited investor. but there is still a large hurdle for the average person who may be super knowledgeable, right? Could be any of us, assuming we didn't meet any of those, wealth thresholds. People who work in private equity, people who maybe have consulted with or do this as their day job. Some of those people may not still qualify as an accredited investor, which is a little bit ludicrous, right? Because a lot of those people probably have a lot more knowledge of how the private markets work, of how to look at and assess a early stage investment opportunity, and yet they're not accredited, which means some of these investment opportunities are off limits to them. Now, some of the different things that are in those bills, for example, would be mandating that the SEC comes up with an exam, so it'd be based more on knowledge rather than just this arbitrary wealth threshold. In addition, some of the other ones, right, are trying to either freeze it for inflation adjustment or make inflation adjustments. There's a whole bunch of things that are being talked about. Honestly, it's probably going to go to the Senate. The Senate's going to chop it up and do their own stuff in terms of other updates. But, Scott, Teddy, I'll turn it over to you guys. Just in terms of what is being talked about, what do you think, could be the impact of this for investors and for companies, right? If you're opening up the investor base, allowing more people to become accredited, does that move the needle?
Just off the top, they make idiots in all shapes and sizes. Doesn't matter how wealthy you are. I know people who are incredibly wealthy who don't know anything and their investments are just atrocious, and I laugh. And I know people who have not a pot to piss in, and they're some of the smartest people I know. So I think that's always been something that has boxed out people, and it's actually not like good for us as investors. This is not inside information or anything. This is more just kind of what I'm reading tea leaves, and then I'll hand it to Teddy to kind of assess whether he thinks I'm nuts here. I think that I think the end outcome here is going to be that there's you still qualify as accredited if you're rich. Like the QP levels down to accredited 3 million, 5 million to 3 million, 300,000, whatever. Like then they might even loosen it up a little bit or make it a little bit easier to jump the hurdle. I believe that they are going to come up with like a Diet Coke version of the Series 6 so that anyone can effectively, look, anyone can become a realtor, and arguably that's like a bigger risk than like investing your own money. So like I think that is a foregone conclusion. I will just add to this, and it goes into the next topic we're going to talk about. So it's kind of a good lead into that in the future. I think there was a lot of pressure about a year ago from not like I would say private equity firms, big firms who are handling a lot of money to be able to access retail capital. And it's been something we've been talking about and hearing about for the last year, but like the last 6 months has been crazy, right? All these private credit funds and BlackRock and Vanguard and Case and ICAP, everyone's jumping. I think there was a lot of pressure put on the committees to loosen up accreditation rules because they thought that was their path of least resistance to access retail capital, and therefore they lobbied their asses off and we're seeing immediate action. I think you're going to see what I just said happen, but I think you're going to see this process slow down over the next couple of months to year, and maybe even just become kind of like back to the pace it was at before, because, and we'll talk about this again in the next segment about Donald Trump and the 401k. I think that these firms and funds discovered that what has been a 15-year struggle with no movement, allowing retirement funds for retail to be invested in private assets, they got it. And I don't think that they thought that was going to happen. And I think that they realized that that is a better avenue for them to acquire retail capital for better or for worse, to create liquidity for existing LPs and to add new capital to their investments. I think they figured out that's better. And because of that, something they didn't think was going to happen, they're now going to let go of lobbying so hard for accreditation. They no longer give a shit about our individual investor rights. They just wanted access to retail capital. I think they got it. And so I think what you're going to see here is, sure, progress, voted overwhelmingly so. As an investor, very excited about it. But also as a realist, I think that you're going to see this micro move forward and sort of like, okay, cool, they got what they wanted, leave us alone. And that's what I think is going to happen. Teddy, am I completely fucking nuts or paranoid, or do you agree? What do you think?
Yeah, I think you put it quite well, Scott. I think opening up alternative investment, startup investing to the masses is something we're all about as people that work in the equity crowdfunding space. So, the way I've been doing this as someone that's non-accredited so far, Hopefully that'll change eventually.
Couple
But
deals, couple deals
yeah,
come
I
through with
mean,
the old Gordon Gecko, bud. You'll be right there. Got a lot to learn, buddy boy.
so what I did was this is pretty off topic, to be honest, but I'm going to say it anyway. So if
Go
you
for it.
so I have a self-advised Roth IRA, and there are Roth IRAs, you invest post-tax dollars in public companies, and you get the returns are tax-free once you hit a certain age. So there was one company, Monogram, that I had really liked. They were their robotics surgery company, and when they went public, as happens very frequently with IPOs in this space, it cratered pretty quickly. And their market cap was like 50 million, 60 million, which is like way under what they raised their Reg A at. So I slowly just dollar cost averaged into Monogram because I knew the business quite well. I've talked to them a bunch of times, and I like knew it was undervalued. So I just like kept slowly putting it in, building a position there. And then they got acquired at like 200 million, which was again
Nice.
which was like below what their last Reg A was. They went public via Reg A.
Yeah.
And so that was an equity crowdfunding company. I followed them post IPO and ended up doing pretty well on it. So
What do you think you need to know? Like, obviously, there's a test, there's a driver's test, there's a realtor test, there's all kinds of tests that we all take in life. The government Constitution test. I don't know shit about the Constitution, but I passed it one day. What do we need to know because we're not here for the firms to make money. I mean, sure we are because the economy needs to work a certain way. We're here for the investors. We want investors to have access, and we want them to be protected and have smart access. And we obviously at Kingscrowd try to help them with that. But what do you think you've learned over this period of time? And obviously your financial background, but like, what do you think these investors need to know minimally before they should be getting investing? Because my argument would be there's all kinds of opinions about what's a good company, what's a bad company, and even the foremost experts in topics get it wrong. To me, I need to understand the rules of the road. I need to understand what happens when this goes public, what happens when this goes bust, like, should I have QSBS protection? What does that do? How do I protect myself tax-wise? Like, is this a waste of time? That's the stuff that I think we need to really know about, and that's what I'm curious about. Like, and Brian, maybe you know this, I don't know. I don't know what focus has been paid to that versus like, we want to make sure you don't invest in a scam, because I actually don't think that's the biggest issue here.
Right. That's a part of it. But again, when they're in the Reg CF space, the funding portals are supposed to be doing like bad actor checks, right? Like they take some of that load off. So you're not doing background checks on founders, right? That they should hopefully have some of that covered. Now, that being said, I agree, Scott. I think some of my biggest learnings since I got into this space was just like a fundamental understanding of what you're investing in. So you understand if you're investing in common stock versus preferred versus a safe. None of those is necessarily like better or worse than the others, but they're all different. And depending how the terms are set up, it can mean very different things for the outcome. Like if you're investing in common stock in a company where there's a ton of preferred that have a 2x liquidation preference, and that doesn't have a big outcome, you're going to get screwed. So just having that understanding, you might still decide to invest, but you need to understand how that math works. To your point, the exits, like how do you actually get your money out? Timeline expectations. I think a lot of investors have, they're kind of unreasonable. It's like, oh, cool, I can invest in this high growth startup. They don't understand their money might be locked up for 5, 10 plus years. That's kind of a basic thing, right? And you can't just sell it. Like at least today, there's still not a lot of liquidity on secondary markets. So you're doing this and you're kind of letting it ride, which in my opinion can be a good thing because sometimes it protects humans from our most, negative behavioral psychology where you're going to want to sell at the worst possible time. And that might be the exact time when the company turns around. It's been tons of pivots and tons of success stories like that from huge companies. So I would say like a basic understanding, functional understanding of the markets, how they work, what you're investing in, like the types of risks, those types of things. I agree, Scott. I think everyone's going to have their own opinion in terms of, is this a good company? Is this not? Oh, I think they have, really good market potential. Oh, I think they have a ton of risk. That's very subjective. That happens in the public markets where everything is 100% disclosed. There's complete disagreement, right? So you're never going to get around that. But I think what we need to help educate investors about is like, just because your company failed and went out of business, that doesn't mean it was a fraud. It doesn't mean it was a scam. Right. And that's what I see. A lot of times when companies announce they're shutting down, it's like, how do we sue them? How do we do a class action lawsuit? It's like, you need to understand going in so that that doesn't happen at the end, because I think if that happens, you're going to scare all the good companies away from wanting to do this as well. So
yeah, I mean, it's an understanding that venture capital startups is like the only industry in the world that an 80% failure rate is just like what it is. And like 8 out of 10 startups go out of business. And the people that aren't familiar with the space, that just see a company that, you know, a startup that looks great, you know, they're, you know, have a good amount of traction, great team, and they make an investment, and maybe it's their first one. And if it goes out of business, they have the reaction you just said, Brian. How do we sue them? Like, how could they lose my money? But people need to be educated. That is just the name of the game. It's, you know, 20% of the companies will make up 80% of your returns, whatever it is. Like, it's just how this game works. And I think people need to, some kind of test needs to be done with that. You can prove that if that happens, you're not gonna like freak out and start saying you're gonna file a lawsuit or something.
There needs to be that line in there that tells you like, hey, this is like the odds of success. Not dissimilar from what like Morning, and I guess Kingscrowd literally does that. So if we expanded it to startups in general or other assets, it would be even more valuable. But like what Morningstar does in Robinhood, like the stewardship rating, like, you know, whatever, risk, bearish, bullish. I, to this day, have investors in my business, in Kingscrowd's business, who get very personal about stock, get very personal. We're talking about Wall Street again here, quotes from Wall Street. Don't get personal, bud. They take it personally, and like they're incredibly wealthy, and the amount of money invested is like not that much, but they freak out. And so like that's a personality type. I don't think we're ever, no matter what test we give them, I don't think we're ever going to have someone who's not going to get litigious or get, you know, butthurt over a bad deal or whatever. Like, it's of course never their fault, right? It's always your fault that they invested in this. So like that part's, I think human frailty is a waste of time to try to solve around. What we need to solve is like, do you understand the rules of the road? Do you know how to turn the car on? When the car is about to crash, do you not open the door and get the fuck out? Like, that's what you need. And that's what we need to do. And I think Kingscrowd does an incredible job. Brian, you do an incredible job stewarding that and championing that. And I hope that the legislators and regulators allow us to continue to move the ball forward. And what I'm about is optionality. I just want to make sure that any investor who maybe doesn't meet it because they're a school teacher, they don't meet the minimum, but they are smart as hell and they want to pass the test and put $10,000 in a deal, they should have that right. So as long as that's ultimately what comes out of the Senate, I hope that's the case. And I think just to move the hockey puck down the glass or ice here, Brian, the big end to me is that I think that what has transpired with Trump and 401k retirement investing retail has had a huge impact as to what is going to come from this retail accreditation bill, so to speak. So why don't we talk a little bit about that next? Because I think that is really a huge topic of the shift of where things are going.
So as Scott mentioned, and again, every week I feel like we have some announcement of some new private asset manager or wealth manager, making announcements, launching stuff for the retail public. This is a huge deal because basically what happened, so President Trump last week signed an executive order that basically approved alternative assets, private assets, that includes digital assets, right? So crypto getting lots of publicity there, for individuals holding in their 401k plans and other kind of defined contribution plans. So what this means, right, is you go into your 401k today, which are usually your employer-sponsored plans. You can choose a bunch of different funds depending on who your 401k is set up through, right? Maybe you have Fidelity, maybe you have Vanguard or something else, and you contribute to that every pay period. Now, this is a huge, huge source of all the locked up capital, right, and investment capital. I think there's trillions of dollars of AUM, assets under managed, right? The more cynical take, right, is this is another way to get retail to get their money, to put this in the hands of private assets, private companies. Now, a more positive view on that, right, is you could think of the 401k as a long-term investment vehicle. You're not supposed to be touching this until 65 plus when you retire. Startups and early stage investments are meant for long-term investing. You can't be short-sighted. You need to hold these things for really long periods to sort of see potential returns. So there's really good potential alignment there. Scott, you obviously have some opinions on this. I'm curious to hear, what do you think in terms of the 401k?
I'm mostly positive. in the sense that obviously I've been talking about this and worked with Republic to bring the Hamilton Lane to retail. Like I am obviously a huge believer and investor in private equity. Uh, I think that private equity is something that, while I do think that the tokenized RWAs and all these other things that are clearly going to be adopted over time, it's still TBD as to what pace and velocity. Having the ability to trade in and out of your position to fund other things, I think inherently is probably a good thing. But the true value of private equity is that it doesn't have volatility and that it is a long term and a compound interest and there's tax advantages. And so long as the tokenization isn't the actual exit of the asset, but rather the ownership right, the title of it, I think it's ultimately going to be fine. I think that retail should still have access through different ways to get into private. I think that the CEO of Thoma Bravo said it best when he was like, my biggest concern here would be that smarter, big air quotes, smarter rich people from BlackRock and other are going to make a determination as to what is a good asset for you and be able to say, well, we're going to take your money today, buy it as a secondary, create liquidity for existing LPs to reinvest into other shit. And you've got 25 years for it to mature anyway. So what does it matter? And that is a dangerous play because it just reeks of 2008. We're just going to tranche and bundle good, good credit with bad credit and good investments with bad investments and illiquid investments. And we got to get the money back to our LP so that they'll put new money back into our fund. That's the negative. That's to assume that all their investments are bad, which are not the case. Like most of these funds have had, generally speaking, IRRs that are seemingly good. Obviously, that can change when you try to liquidate. But I think that they're mostly good investments for the people we're talking about. So the negative would be like that they're not, but the positive is that I do think that you need some exposure to private, and I actually think that the long-term incentive that firms and funds like BlackRock and Hamilton Lane and Blackstone and KKR and etc. is that they do need a new source of capital, and so with AI, what happens to education and endowments and pensions and things like it's unknown. There's 15 trillion sitting there. There's another 70 trillion in generational wealth transfer, people who've never had access to banking like this before. So like they're incentivized to perform well. So I actually don't think it's going to end up with a bag holder scenario. I'm sure there'll be some losers in it. There always are. But I don't think that's the issue. But I do fundamentally believe that how we got here is very wealthy people put a lot of pressure on a president who has, if you're watching any of the news lately with the media deals and Paramount and everything else, like Redstone, he clearly has a penchant for being bought, for lack of a better term. And I don't mean this politically, it's just the man. So I think that they lobbied really hard against him, and he's a person who can be swayed and purchased, so to speak. And other presidents, good or bad, have not. And that's not to say the decision he's making is good or bad, because that I actually think it's probably good long term. But something that's been like 10 years in the making, never had any progress, and all of a sudden overnight it did. And I think all of these firms and funds need liquidity right now. Trump needs the market to continue on its path. And I think that they made this move happen so that we could get capital from retail to trade places with long-standing 12-year holders of LP money. And I think that's actually what happened. I don't think it's going to poorly or anything, but I do think that the reasons are not necessarily for the retail investor, to put it mildly.
Teddy, so you already mentioned, you invested or, potentially through some different ways. If they open this up, tomorrow and you could start investing in private assets through your 401k, what do you think of that?
I'm curious to see what the mechanics are going to be. So is it, because like the way 401k works for most people right now is you can kind of allocate it to different funds that are very safe. And yeah, do you know, Brian, like how's it going to be structured? Is it going to be is there a little group basket of,
so the initial, I'm sure there's going to be multiple ways to this, but there's several partnerships and there's several ways to do this. If you have a registered advisor or you're self-direct through Fidelity, if you're through an advisor who uses what's called a TAMP or a UAM, you probably will actually have kind of choices, not dissimilar from the wealthier people. And if you're accredited, you definitely do. For retirement packages, KKR and Vanguard and BlackRock and Blackstone have all put together through iCapital, which is also the same tool that all of the RIAs use for their clients anyway. effectively packages that are a combination of like looking for X yield, looking for X credit return, wanting investments in infrastructure, wanting investments in growth tech. It's going to look really not dissimilar from what you would do as an index fund investor.
Mm-hmm.
And then the last piece of this, that's just going to be the next evolution, and I already am seeing it come out, so I know in 2 or 3 weeks we'll be talking about this again. Almost every one of these funds is lifting an interval fund that they want to actually make available direct through Accredited. That's like weeks away from being mainstream. So this is like, I think the goal that they're shooting for is like, if we could, I'm just guessing, I don't know anything, I'm just guessing that they've done reverse calculation here. If they could get 5% of every retail portfolio that's managed by an RIA or an advisor of some sort, and just allocate 5%, and over time you can increase that or decrease that as redemptions are available, that's their goal. And I think Larry Fink came out about 6 months ago and said the new portfolio for everyone should be 50-30-20, 20 being in private. That's aggressive. So I think what you're going to see is like a 5% starting point. You're going to look at an index fund. It'll be searchable on Morningstar. Almost guarantee you every fund that's going to be part of this partnership has got at least a 10-year history. So like I said, I think that there are protections in this that are made not just because it's like the law, but also because they do really want these investors, retail and otherwise, to continue to increase their allocation over the decades to come. But I believe your bundles you're going to look at right now are probably represent like 30+% of KKR's portfolio. So it's not just obscure shit that they threw together, though I'm sure that does exist when one were to dissect.
So Scott, I got to ask, because it sounds like you have a really good understanding. You've done a lot of work kind of in this space. Do you see, a lot of, I think what you've been talking about are the names of, the Blackstones, KKR, Vanguard, Fidelity, et cetera. Are people going to be able to invest in individual startups? Do you see that as something happening within 401k plans, or is that something more attributed to being outside of that kind of framework?
So that's a question of not immediately. I think if this is self-directed, that's a different story. That's like go through Alto and you're using an IRA, which is, I understand, not the same thing. But like if it's self-directed, that's going to be kind of up to you. And it won't be retirement directly, although IRA is arguably that. If it is managed asset, you will probably eventually see a private asset manager who uses artificial intelligence to do his or her job, who can select different deals that are later stage pre-IPO. I would be very, very surprised if it was managed and it was investing in startups direct. So what I think you're going to see happen is, and you're already seeing it underway, Sequoia, everything they invest in now ultimately funnels to a permanent capital vehicle. A16Z is more or less an RIA at this point. GCV and GA, General Atlantic, General Catalyst, already doing the same thing. You're going to start seeing, a lot of these funds, VCs, turn into RIAs, but are just a venture portion of private equity. And you will see allocations into the, growth fund 2 of Sequoia. And you will have exposure to all of the early stage businesses, mid, late stage businesses Sequoia has invested in through your retirement account based on their investments. That is how funds and private equity funds and unregistered 3C7 and 3C1 hedge funds are operated. So I suspect that these financial people are not that creative. They will just copy what has already worked. And you'll just start to see the extension of what is already the case for private equity extending into venture capital. And that's most likely the case. The only other thing that would happen here, again, is if the accreditation laws loosen, everyone is a qualified purchaser could do this already. So that's different. Accredited and QP can use IRA. Retail, I think, will always not have access to direct unless they are accredited through some formality. That's my take. Semi-educated take.
Yeah. Well, we could obviously talk about this all day, a lot of speculation. I think it's still to be seen kind of what the final implementation will be. So I think we can.
This is all exciting, guys. Like, this is stuff we've been talking about for 4 years in our like rooms, and no one gave a shit, including our spouses. And now it's like every week we're on here talking about another breaking news. It's crazy.
I was just gonna say that it's we have too many topics to talk about each week, whereas before we were trying to search for things to talk about. So, I think if the past few weeks and months have been any indication, there'll probably be lots more announcements to come this year, and lots more developments. But let's wrap things up there. One other thing I forgot to talk about at the top of the show, but we want to make everyone aware of, if you enjoy a lot of this discussion just around private markets, around investing online and in startups, check out the Kingscrowd Investment Crowdfunding Week. So this is the premier kind of online full spectrum from seed to scale investment journey where Kingscrowd, our company, is going to be hosting it from September 29th to October 2nd. It's going to be all online, but we're bringing together kind of both sides of the marketplace. We'll have all of the founders who are just getting started, founders who have raised tens of millions of dollars in capital, and investors and marketing agencies and everyone else that is so critical to this ecosystem. We're getting together to be able to share all of the best practices, lessons learned. We're going to have 4-day virtual event, basically. So we'll have pitches from companies, we'll have platforms there, and all the other industry leaders. If you have any interest in this space and being kind of plugged into just being at the forefront of what's going on, make sure you check that out. We are just saving the date right now, but we'll be opening up registration. We'll also drop a link for that pre-registration into the chat below this video. So make sure you can check that out if you want to pre-register. Investment Crowdfunding Week, September 29th to October 2nd. Make sure you mark your calendars. With that, I think we can wrap things up today. Scott, Teddy, always a pleasure. I'm sure we'll have lots more good things to talk about next week. And for everyone else out there who is watching, want more great data-driven insights like what we've been talking about today, get them delivered straight to your inbox. Head over to kingscrowd.com. Free to sign up. We get free portfolio tracking. You can see all the deals that are currently have offerings online and be able to get great analysis and data-driven insights and join our weekly newsletter. So until next week, we'll see you guys back here. Thanks, everyone.